If you've ever glanced at a stock chart with a series of small dots hovering just above or below the price line, tracking it like a shadow, you've seen Parabolic SAR in action. It's one of the most visually recognizable indicators in all of trading, and it comes from the same mind behind ADX, RSI, and ATR-J, Wells Wilder Jr. But today I'm not testing it on a stock. I'm testing it on gold, an asset with a completely different personality than equities, driven by very different forces: inflation expectations, currency movements, central bank behavior, geopolitical fear. I'm coding Wilder's actual Parabolic SAR system and backtesting it on 10 years of real GLD data. No cherry picking, no curve fitting, just the raw numbers. SAR stands for stop and reverse, and that name describes exactly what the indicator was designed to do. Unlike most of the indicators we've covered on this channel, which generate a signal and then step back, Parabolic SAR is meant to be a complete, self-contained trading system on its own. It tells you when to enter, and it continuously tells you where your stop should be, updating every single day the trade stays open. This was a genuinely novel idea when Wilder introduced it in 1978. Most trading tools up to that point either told you when to get in or offered some fixed rule for when to get out, but rarely combined both into a single continuously adaptive line on the chart. Parabolic SAR effectively fused entry, exit, and risk management into one visual tool, which is part of why it became such an enduring fixture across nearly every charting platform that followed. The mechanics work like this. The indicator plots a series of points, either below the price during an uptrend or above the price during a downtrend. As the trend continues, those points gradually accelerate closer and closer to the current price, which is where the parabolic part of the name comes from. Since the rate of acceleration itself increases over time, tracing out a curve rather than a straight line. When price eventually crosses through that dotted line, the indicator flips, the dots jump to the other side, signaling both an exit from the current position and, simultaneously, an entry into the opposite direction. The clever part of Wilder's design is something called the acceleration factor. Each time price makes a new high during an uptrend or a new low during a downtrend, the acceleration factor increases slightly, causing the SAR dots to creep closer to price more aggressively. This means a young, freshly established trend gets a wider berth, more room to breathe without being stopped out prematurely, while a mature, extended trend gets progressively tighter protection, locking in gains more aggressively as the move matures. This built-in adaptiveness is part of why the indicator has remained popular for decades. It doesn't use a single fixed distance for its stop, the way a simple percentage-based or dollar-based stop-loss would. It responds to the shape and maturity of the trend itself. It's worth pausing on why gold specifically makes for such an interesting and genuinely different test case compared to everything else covered on this channel so far. Every strategy tested up to this point has been applied to either a broad equity index or an individual company stock, assets whose long-term price behavior is ultimately tied to economic growth, corporate earnings, and productivity. Gold operates under a completely different logic. It produces no earnings, pays no dividend, and has no revenue growth to speak of. Its price is driven almost entirely by macro sentiment, fear during times of crisis, inflation expectations, real interest rates, and the relative strength of major currencies, particularly the US dollar. That means gold can trend powerfully for years when those macro forces align, and then sit in frustrating, directionless consolidation for equally long stretches when they don't. A very different rhythm than the earnings-driven, generally upward-biased drift of the broad stock market over multi-decade periods. For this backtest, I'm using the indicator specifically as an entry trigger. When the SAR flips from above price to below price, that's the entry signal. For consistency with every other strategy tested on this channel, I'm still using our standard 2x ATR trailing stop for risk management going forward, rather than the SAR zone continuously updating stop level, which means this test isolates Wilder's entry logic specifically, rather than his complete original stop and reverse system exactly as designed. Gold is a genuinely interesting test case for a trend-following system like this. Unlike a growth stock, gold doesn't have earnings reports, product launches, or company-specific catalysts. Its price action tends to be driven by macro forces that can persist for very long stretches. Multi-year bull markets during periods of high inflation or currency weakness, and equally long stretches of sideways consolidation when those forces fade. That kind of environment can be either extremely favorable or extremely unfavorable for a trend-following approach, depending entirely on which phase the tested period falls into. Here's exactly what I tested. Parabolic SAR trend following, applied to GLD, using 10 years of daily price data. Starting capital was $100,000. Every SAR flip that crosses bullish triggers an entry, mechanically, with no discretion involved. So how did one of Wilder's most iconic indicators perform on 10 years of real GLD data? The strategy executed 92 trades, with a win rate of 43.5%. Total return came in at plus 148.2%, working out to a compound annual growth rate of plus 9.5% per year. For comparison, simply buying and holding GLD over the same period returned plus 187.0%, or plus 11.1% annually. The strategy's maximum drawdown, the largest peak-to-trough decline an investor would have had to sit through, was minus 12.5%. One well-documented characteristic of parabolic SAR is that it tends to perform very differently depending on market conditions. In a market with long, sustained directional trends, the accelerating stop mechanism can do exactly what it was designed to do: stay in the trade through the bulk of the move, then lock in gains aggressively once the trend starts to mature and slow down. But in a choppy, range-bound market, the same mechanism can generate a rapid sequence of flips back and forth, entering and exiting repeatedly without ever capturing a meaningful move, since the dots simply oscillate along with price rather than following any coherent trend. This sensitivity to market regime is arguably the single most important thing to understand about SAR-based systems generally. The indicator doesn't distinguish between a market that's trending and a market that's merely drifting sideways with random noise. It reacts identically to both, which is precisely why some traders choose to combine it with something like ADX to filter out signals during periods when trend strength is genuinely weak. That combination, SAR for timing, ADX for confirming the trend is real, is a natural next experiment for a future episode on this channel, layering two of Wilder's own tools together rather than testing each one in isolation. Gold, in particular, has gone through both kinds of regimes repeatedly over the past decade. Extended rallies driven by macro uncertainty, followed by long, frustrating stretches of directionless consolidation. Testing a trend-following tool like this on an asset with that kind of mixed history is a fair, honest stress test, rather than cherry-picking a period where trend following was guaranteed to shine. It's also worth noting that parabolic SAR remains one of the few Wilder indicators from that same 1978 book still used today largely in its exact original form. RSI has been endlessly modified and combined with other tools over the decades. ADX is frequently paired with additional filters. But parabolic SAR, in most trading platforms today, still runs on essentially the same acceleration factor formula Wilder originally published, a rare example of a nearly 50-year-old formula surviving almost entirely unchanged in an industry that constantly iterates on everything. That's the parabolic SAR trend-following system, coded and backtested on real gold data. Wilder's stop-and-reverse concept, applied to an asset class far outside the stock market where most trading strategies get tested. If you want to